Hello students, welcome to Legacy IAS Academy. Today we are going to discuss about a recent report that has been released by the Reserve Bank of India that is called as Financial Stability Report, or also referred as FSR in the short. And also we are going to discuss about what are the main takeaways or what are the important points that we can understand or take away from this particular report to have a proper understanding or have a brief understanding of the financial situations and the banking situations in India. So let us start and delve deeper into. So first of all, if we try to understand some important points or backgrounds of this report. So this report, as we discussed, is published by RBI every twice a year, that we can say every 6 months, one time this report is published. And as a part of this financial stability report, RBI also take an exercise that is referred as SRA, or systematic risk survey. Under this systematic risk survey, RBI tries to assess the financial system on 5 main types of risk that it faces. First, the global risk due to change in the global macroeconomic situations, the financial risk, the macroeconomic risk that is at the domestic level, and as well as the institutional risk as well as the general risk to which the different financial institutions are exposed to. Overall, if you try to understand the objective of, so it is basically to gauge that how our financial system, especially banking system, will respond in case of any adverse situation or any adverse economic situations that develop both at the domestic level as well as at the global level. Now, if we try to understand that what this report means mainly to tell us, so basically 3 things are there. First of all, this report gives us an idea about robustness or vulnerability of financial system. That means on a stronger side or on a positive side, how robust our banking or financial institutions are to face a risk, or on the negative side, how vulnerable they are in case certain risk arises in the economic situations of the country. Second, this also gives us an idea about how the financial institutions are related or can be responsible for the future growth. That means we can say talk about the financial institution, whether it can be banking institutions or it can be non-banking financial institutions, how both of these institutions can help in future growth of the country. That means if not in here, actually it tells us 2 things. First of all, it tries to understand the NPS, and second, it tries to understand the fiscal deficit to understand that what degree financial institution can contribute for the future growth of the nation. We have to understand the state of NPS of the financial institutions and the fiscal deficit of the government. Now, what is NPAs? NPA actually stands for non-performing assets. Non-performing assets generally are those assets where bank has given loan to certain customers, especially we can say high capital loans, and they have not been able to pay back either the principal or the interest for at least 90 days period. That means if for continuously 3 months the bank, we can say borrower have, if they have not been able to pay back money or interest as well as capital to the bank, then it's classified as NPA. Second, fiscal deficit is actually considered as overall what the government is getting and what the government is spending. So if both of these are high, that means we can understand that banks are not in the right condition to suit, or we can say to sustain or support future growth. And also if fiscal deficit of the government is high, it means the government does also not have enough money to spare and to bail out in case of banking failures. So that is why both of these data are very important to understand that what should be the, or what will be the trajectory of future growth of the nation, and how the banks are, how vulnerable or how robust the banking institutions of the country are. Now, if we try to understand from this particular FSR that has been recently released, so first a takeaway point is that we are observing a general loss of momentum in the global recovery after the COVID epidemic. And to prove this point, what we see that we see a supply disruption on the global level. We see increase in the inflation level across major countries of the world. We see even these problems not only in the poor countries or countries which are least vaccinated, but even in those developed countries which has been able to vaccinate its majority of the population. So we can understand this is not a localized risk. This is not a particular risk for a particular countries, but it is a global risk. And thus overall these all can contribute or is contributing to the loss of momentum in global economy. To understand this point, we can look at 2 different data or 2 different we can say a scale that is used by RBI. So first is the goods trade barometer. So if you look from this particular chart, what we are seeing that since June 21, that is between June 20 to June 21, this goods trade barometer that gives us idea about the goods trade that is happening at the global level. We can see earlier between June 20 to June 21 it was rising, but since June 21 till September 21 we are seeing a sharp decline in that. Almost 22% decline has happened in the aspect of good trading at the global level. Second data to corroborate the same point is we are also seeing a sharp downtick or downtrend in the Baltic Dry Index. For those who do not know what is Baltic Dry Index, actually this index measures the shipping charges for the commodity goods that are traded at the global level. So both these downtick shows us that overall the sentiment of trade is on the negative side, or the overall the volume of trade or the value of trade that was being done at the global level in the last 1 year is slightly on the decline. So that assert or that corroborates our first takeaway point. The second takeaway point is what RBI has suggested, especially with reference to the Indian market, is there is very strong level of disconnect between what is the state of real economy and how India's equity markets are responding or are growing. And what we see in this particular point, that first of all, we are observing bull run not only in Indian market but all across the globe, where a lot of investors are rushing to buy shares and equities of different companies, and that is causing, due to high supply, that is causing sharp uptick in the prices of the different companies. Second, it is because of, as we discussed, a strong investor interest, and even that lot of, especially if we talk about the case of India, a lot of young investors are now coming into the market and are investing in a very massive amount. And we can corroborate this from the same point that recently SEBI has said that there is very strong increase or very high increase in the inflow of both mutual fund as well as the equity market in India, in the equities in India. And this has caused a very high level of divergence between the real economy and India's economy. And to understand this point, we can look at from this particular data that if you look at the P by E ratio of overall market, it is at historical high, especially in last 10-year period, and that also India has the highest P by E ratio as far as its Sensex or its, sorry, as far as the equity market is concerned. If you look at other countries like USA, it's 26%, 26, Philippines it is only 17%, Indonesia 14.9%, and in some countries like Russia and South Africa it is even in negative territory. However, India has a very strong P by E ratio. Now P by E ratio, what it tells us? It tells us that P by E ratio is the price of the share, that is current price of the share of any particular companies, equity of any particular companies, and overall it is the earning per share that gives us P by E ratio. That means if P by E ratio is very high, it is considered the market is either overvalued or investors believe that there is very high growth potential in that particular companies or overall market in the long term. And if P by E ratio is very less, that means we can say that a market or the particular company is undervalued. Second point is that if you look from other some valuation metrics to understand the market direction, P by B ratio, long-term average in case of India has been 3.26 and current average is almost 3.58, that is also higher. The market capitalization, that is the total dollar value of outstanding share of any particular company in the market, to the GDP ratio is also at all-time historical high. The long-term average was 75 and as of now its present we can say current value is 119. Similarly, the price earning ratio that is determined by Shiller's formula, Robert Shiller, who was the Nobel Prize winning economist, as per him also, if you calculate this P by E ratio from his formula, we also seeing a very sharp increase or very we can say high level of P by E ratio as compared to the historical level. So all this says that there is a strong level of disconnect, and this is not the first time when RBI has actually said that we are seeing a disconnect between actual economy and the trend of overall market, and this actually causes a problem because it challenges the stability of the market. And in case if economy does not fail or economy fails to shoot up, in that case it can burst like a bubble, can cause large scale damages to the especially retail investors, and can wipe out the wealth of lot of people. The third takeaway point is regarding to the growth of bank credit. And what we are seeing in general trend that the bank credit growth is improving, but it is not improving fast enough as RBI has expected. And to prove that point, what we are seeing that a banking stability indicator, the indicator shows the stability or the we can say stability of the banks, basically based on we can say capital, how much capital does the bank have, capital adequacy ratio. Apart from that, it also look at the liquidity, we can say liquidity. It also look at the stability, how stable the bank is in the long run. Apart from that, it also look at the profitability. So several parameters are there on the basis of which BSI is calculated, and overall in terms of India's bank, we are seeing an improvement in that particular indicator. Second, we are also seeing improvement in the credit growth rate. However, what we are seeing is that we are seeing stress in the microfinance industries, that is in there. And to prove that point, we can look, if you look at the credit growth in the India, especially with respect to the scheduled commercial bank, what we are seeing here that overall credit growth is on the path of recovery. If you look clearly here, it is a W shape or also called as U shape recovery is happening. However, the problem or issue is in the context of retail credit growth, where we are seeing a decline in the retail credit growth, and also the wholesale credit growth, which is also currently in the negative territory and have just emerged. But important point here, what RBI has observed, that whatever credit growth that is happening in the wholesale level, it is happening by the public sector bank. Private sector banks, on the other hand, are not very interested or keen in deploying their capital for the growth of the economy or the growth of the different industries. And this we can see, the third point that we discussed, that there is incipient stress in the MSME industries, and that is clearly seen from this point, that in March 21 the exposure to MSME was 8% and aggregate exposure was only 4.5%. However, in September 21 it has declined to 0.28 and 1.90. That means the financial institutions, whether it is a banking institutions or non-banking financial institutions, they are wary of lending to the MSME industries, mainly because of the COVID issues and also because of the lack of understanding that how economy will recover in the shorter term as well as in. The fourth takeaway point, which is very important, is that RBI has said that NPAs by September 2022 may see a sharp rise or sharp uptick both for private sectors as well as public sector bank. And for understanding this, they have actually done or did a stress test. Stress is done by RBI to understand the vulnerability of banking institutions, financial institutions, and they actually try to we can say include adverse economic scenarios, and they try to understand that in case of worse scenarios or good scenario or better scenario, or we can say like overall different bad economic scenarios are there, how different indicators related to the growth and financial institutions will react. And for that, first of all, they take into account the GDP growth, how stress will cause changes in the GDP growth. Second, they also try to understand how CPI inflation will vary under worse or deteriorating economic scenarios. Third, they try to understand how export to GDP ratio will vary. Fourth, they try to understand how the current account balance to GDP ratio will vary. And fifth, they try to understand how weighted average lending rate will vary. And finally, how the fiscal deficit to GDP ratio will vary in case some adverse economic situations, we can say, develop in the countries. And that is the whole we can say objective of a stress test, to understand that how these different indicators, overall macroeconomic indicators, will react to what. And what we have concluded, or what RBI actually have concluded from this stress test, that the gross NPA ratio of all scheduled commercial banks may increase to 8.1% by September 2022. And within this scheduled commercial bank groups, we can see a sharp increase in the gross NPA ratio of 8.8% by September 2021. Sorry, it was 8.8% for the public sector banks in September 2021, and within 1 year it seems, or it feels that it will deteriorate to at least 10.5%. So this is a worrisome scenario, because the increase in NPA means that banks will have less capital to deploy in the market. If banks have less capital to deploy in the market, that means the growth momentum that RBI or the government is expecting will not happen at the same rate, and overall the growth of economy will suffer. And as the growth of economy will suffer, obviously its implications we can see in all spheres of life, whether it is unemployment, whether it is the creation of new job, whether it is increase in the salaries, the tax the government is getting, everything will impacted, and that is not a good scenario for India. The last point is about what we are seeing in terms of prospects, that the survey was conducted among different respondents group, and how they have responded, that what they view in the terms of prospect for the Indian banking sector 1 year ahead from now. So in there we see a slightly encouraging prospects, where if you look at this graph, you can clearly see that now this violet line shows the assessment that was done in November 2021, and this yellow shows assessment that was done in April 2021. So as you can see, in April 2021, only 10% of respondents believe that the banking situation will improve marginally, while in November 2021, this figure has increased to 45.7%. That means now 45% of India's population believe that the banking sector is on the path of improvement, and it's had good prospect in the coming days. Similarly, if you look at the time frame for full recovery of Indian economy, so about 63.9% of this respondents believe that the Indian economy will recover to its fullest extent, that means pre-COVID situation, within a time frame of 1 to 2 years, while the other percentage you can see varies from 2 to 3, 3 to 5 over 5 years. Overall, what we can take away from these two graphs is that overall general belief or general sentiment of the market, general sentiment of the public at large seems to be toward a better scenario, and the belief that banking institutions, financial institutions are on the path of recovery and will recover, not will not take a lot of time to recover, will recover within a period of 1 to 2 years. So this is a very good point. Now, if we have to conclude, we can understand that as per the recent FSR report that has been published by the RBI, what it says that India's banking and financial system has largely improved since the July 2021, but with the global growth faltering, mainly because of the rise of COVID cases again due to the strike of Omicron, that is a new variant, and the sharp increase in the cases all across the world, as well as the monetary tightening that is happening both at the US Federal Reserve as well as by the RBI, especially in the developed countries, which is likely to hurt foreign fund inflows. And due to this, the rise of Omicron, that is also, as we discussed, is going on, the risks are evenly balanced. That means we cannot say that India's economy is going to falter or going to deteriorate very fast, and also we cannot say that India's economy is going to recover very fast. So we have a kind of, as per RBI, it is kind of even situation, and we have to look at how the situations develop in the coming few weeks and months with the rise of new variant, and depending on that, probably in the next assessment report, RBI can give us a much better understanding of how the global economy as well as Indian economy is going to take off from now. So that was the overall brief idea about the important points that we can understand from the RBI's financial stability report. So that is all for now. Hope you enjoyed the session. If you like it, please like, share, and subscribe. We'll come again soon with another interesting and current affairs topic. Till then, take care. Thank you very much.